Anurag, what explains this kind of sell-off that one has seen for US equities? Because many are even questioning whether the bull market is at risk or not.
Aisha, morning. Pleasure to be here. So, look, I heard the discussion. Let me just throw some light on US market. I think the current selling is broadly on account of 10-year yield rising to 10.7, 4.7. And it has done so while Federal Reserve has cut 100 basis points. So it's kind of a counterplay. But I think there are two major concerns, and I think we should wait for Jan 20th to see how it unfolds. But broadly, there is a concern around what are the tariffs going to be. If the tariffs are imposed across the board or even selectively, it's inflationary. Second is what's the immigration policy of the administration? Even that is inflationary, in some sense. So the judgment market is taking is that why not take some money on the side, because we've had back-to-back 25% 2 years consecutive. So that's all that's going around. But I think the 10-year yield eventually should cool down, because I think the last thing the Trump administration wants to do is to rake up inflation again and hold Federal Reserve's hand, to forget cutting rates, but to even raise rates. So I don't think that's happening. But yeah, it's some bit of profit taking. But I think we should have clearer picture after Jan 20th. But aside of that, the big picture on US is earnings are expected to grow 15% on entire S&P, and this time it'll be very broad based. The 493 versus the 7-story, the earning growth in both of these buckets is going to be between 15 to 18% based on what you believe. So if you apply a 25 multiple, 7,000 for an S&P looks feasible, unless something goes seriously wrong somewhere. So that's the big picture, Aisha. It's all clear. US economy and exceptionalism continues. It continues to attract flows, which is, of course, a worry for the rest of the globe, but not so much for US.
All right. Hi, Anurag. This is Shrishti also joining in.
Yeah.
Also help us understand that how do you see the flows coming into the emerging markets? Because definitely, yes, all these investors were pinning hopes on the Trump rally. Let's see that very near to that 20th January date, whether we get to see that or not. But amidst this, the emerging markets are definitely feeling the heat of it. Going ahead, are you expecting some respite into that?
So I think so I'll give you two answers. One is the usual answer. Everybody knows this. If 10-year yield gives you close to 4.5, 4.7 to 5%, why would, and then add to that the currency depreciation, you get 8-9%. Why would somebody stay in emerging markets? That's the short-term story. Everybody knows this. It's done and dusted. But I think eventually 10-year yield should cool down to somewhere around 4 levels sooner, as soon as this anxiety about the new administration policy come into place. That is one thing. But I really want to add something for India here, which is great market, great fundamentals, everything is good. I understand valuation, they will correct in some pockets, but Nifty is all good. But here is a larger concern. I think people, and I think some of the notable investors, notable economists like Arvind Subramanian have called this out. RBI has been holding rupee in a range for the last 18 months. Now, I think if the investors anticipate a severe depreciation in rupee, then they're in a very competitive global capital market flows. You can't really hold currencies. You can peg them for a while, but eventually, investors get a whiff of that, and I think that seems to be the worry. So RBI eventually, aside of the domestic worries, will have to take a call whether they want to keep the rupee floating or what is the range that they are comfortable with. Otherwise, rupee continues to be a little overvalued, at least for now. So that's a major concern, Srishti, for India.
Account, are you saying rupee is overvalued? I mean, if I look at the fiscal deficit of other countries versus now, I mean, we are in the best place.
Yeah. So Nikunj, I think so. One is, again, everything is relative. Look, but when the dollar index moved from 100, 102 to 108, 9, the point is the rupee did not float as much as the other currencies did. So the point is, well, somebody is holding it there, right? So I understand either you follow completely the flow story and the current account deficit story, but if the dollar index gains, the currencies should kind of equally float on a relative basis. So that was my limited sense. But outside of that, Nikunj, we got to trust some of these major economists. I think we got to respect their opinion. Ultimately, third point also is how much does your dollar go in the Indian economy? I think it doesn't go that far at 85. The range should be, I think the consensus is at least around 90 or 90 plus. So RBI has to take a call, either it let it float or, they can peg it, but then the foreign investors will kind of get edgy on the side. I don't have too strong logic to talk about it on either side, but except the fact that the range has been held for the last 18 months, and that's not an ideal scenario. Nikunj.
Sense. Great to have you on the show, Anurag. Thanks as always for your time.
Thank you.
Okay, let's just.
If you like this video, then like, share and subscribe to ET Now.